By the time you're 40, you could be collecting $30,000 a month in dividends. Or you could keep doing what most people do, working harder, saving a little, and watching inflation eat away your paycheck. Most people never figure this out, and that's why they're stuck. But if you stick with me for the next 10 minutes, I'm going to show you exactly how ordinary investors build unstoppable dividend portfolios that grow bigger every single year, eventually paying them more than most people make working full-time. And the best part? You don't need luck, insider tips, or a six-figure salary. Just time, strategy, and compounding. Imagine this for a second. You're doing everything right. You work hard, save a little, maybe even invest when you can. But deep down, there's this quiet fear you don't say out loud. What if this is as good as it gets? What if your income always depends on a job? What if retirement feels further away every year? And what if inflation slowly eats away everything you've worked for? This isn't just a passing worry, it's real. And here's the uncomfortable truth most people never hear. Saving alone won't save you. You can save diligently, live frugally, cut expenses to the bone. But if your money isn't working for you, the odds are stacked against you. That's why Warren Buffett said, "Do not save what is left after spending. Spend what is left after saving." He's essentially saying, make your money work for you. Don't just hope for financial freedom, engineer it. One of the most powerful ways to do this? Building a monster dividend portfolio. I'm talking about a portfolio that isn't risky, isn't a get-rich-quick scheme, and doesn't require obsessing over daily market moves. A system where your money starts paying you whether you're working or not, month after month, year after year. And yes, it's achievable for ordinary investors, not just billionaires. In this video, we're going to break it down step by step. By the end, you'll understand how to choose dividend stocks that grow consistently and safely, avoid the dangerous traps that destroy wealth, harness the snowball effect of reinvesting dividends, turn modest investments like $10,000 into thousands per month over decades. But first, let's start at the beginning. What is a dividend and why does it matter? A dividend is simply money a company pays you for owning its stock. You don't have to sell anything. You don't have to time the market. You just get paid for being an owner. Think of it like this. If you own 1% of a business and that business earns profits, it can either reinvest the money into growth or pay you a portion. When it pays you, that's your dividend. Dividends can be paid quarterly, twice a year, or annually. Some companies are predictable, raising their dividends every year like clockwork. Others are irregular or prone to cuts. And here's the thing most beginners miss. Dividend yield alone tells you almost nothing about your long-term income. Let me explain. Dividend yield is calculated as annual dividend divided by stock price. For example, if a stock pays $4 per year and costs $100, that's a 4% yield. Sounds simple, right? But most investors look at that number and think, sweet, I'll get 4% income. And then they buy a bunch of stocks just chasing yield. That's a trap. High yield is often a red flag in disguise. A company can only pay dividends from profits. If profits fall but the dividend stays high, something's going to break. That's how dividend cuts happen. And when dividends get cut, income disappears, stock prices drop, and panic selling ensues. Let's look at a real-world example. Verizon. Right now, Verizon offers over 7% dividend yield. Sounds amazing, right? But the company has massive debt, over 200% of its assets, and profits have been declining for years. That high yield isn't a gift. It's a potential disaster waiting to happen. Many investors see that 7% and think income secured. But the truth is, if profits continue falling, that dividend can be slashed or eliminated, and the stock price will almost certainly follow. Now compare that with dividend growth investing. Dividend growth means a company pays a dividend today and increases it every single year. The yield might start small, maybe 2% or 3%, but over time, the income compounds like a snowball rolling downhill. Even modest starting yields grow into significant cash flow decades later. Here's a simple math illustration. Suppose you invest $10,000 in two scenarios. Scenario A, high yield, no growth. Yield starts at 10%, giving $1,000 per year in income. You do not reinvest. 30 years later, your investment is still roughly $10,000. You're still earning $1,000 per year. That's it. Scenario B, dividend growth plus reinvestment. Starting yield 2%, growing 10% per year, dividends reinvested. After 30 years, that same $10,000 grows to roughly $190,000, paying around $18,000 per year, about $1,500 per month. Same starting money, completely different outcome. This is what I call the dividend snowball. Slow at first, unstoppable later. Most people quit too soon. Monster portfolios are built by people who stay the course, reinvest consistently, and let compounding work its magic. Even Warren Buffett leveraged this concept decades ago with Coca-Cola. He bought shares at around a 3% dividend yield. Today, because Coca-Cola has consistently raised dividends every year, Buffett earns over 50% of his original investment annually in dividends alone. That's the power of time combined with disciplined dividend growth investing. But how do you make sure you're investing in safe, growing dividends, not traps? The key is safety-first stock selection rules. Before buying a single share, set rules. Don't just follow a hot tip or flashy marketing. Look for companies with consistent profits over multiple years, strong balance sheets and low debt, long histories of raising dividends, reasonable payout ratios. Payout ratio is crucial. It tells you what percentage of a company's profit goes toward dividends. Under 60%, healthy, 60-70%, use caution, over 70%, danger zone. A high payout with declining profits, fractions likely dividend cut. That's why monster portfolios prioritize quality over yield. Companies like Microsoft, Johnson & Johnson, and Visa tick these boxes. Microsoft has raised dividends nearly 20 years straight. Johnson & Johnson over 60 years. Boring? Yes. But boring is exactly what you want when building reliable, unstoppable income. Here's the beginner surprise. Low yield today can become massive income tomorrow. Companies in technology, payment networks, or infrastructure often start with low yields but grow dividends quickly. Microsoft's dividend yield is under 1% now, but it grows over 10% annually. In 10 years, yield on cost could be 3-5%, turning a small dividend today into life-changing income later. Reinvestment is non-negotiable. Reinvest dividends automatically. Let them buy more shares. More shares generate more dividends. That's compounding. Without reinvestment, your portfolio limps along. With reinvestment, it runs. Diversification is next, but don't overdo it. 7 to 10 strong companies across 5 to 7 industries usually eliminates most company-specific risk. Adding 30-40 stocks doesn't reduce risk much more. It just makes the portfolio harder to manage. Avoid having one industry dominate your income. Airlines during COVID, energy during oil crashes. Diversify or risk a shock to your cash flow. You can build this with individual stocks. Microsoft, Johnson & Johnson, Coca-Cola, or you can simplify with ETFs like SCHD, holding over 100 quality dividend stocks, yielding CARB 3.5%, low fees, and 12% annual returns over the last decade. It's diversification in a single ticker. Let's finish this first part with a practical example. Assume 10-12% dividend growth reinvested over 30 years. $10,000, $350,000, $3,000 month, $50,000, 1 knows. 8M, 17,000 month, $100,000, 3.6 million, 30,000 month. No leverage, no speculation, just time, discipline, and reinvestment. Inflation, jobs, social security, irrelevant. Dividend growth investing shifts the equation. You stop trading hours for dollars and start building ownership income. Income that grows, survives crashes, and keeps paying whether you're 35 or 75. Even if you start small, 200 a month, the math still works. Discipline, consistency, and compounding are your best friends. Alright, now that we've covered the foundation, the why dividends matter, and how dividend growth beats high yield, let's get into the real-world numbers and portfolio examples. Because theory is great, but seeing actual growth projections makes this whole strategy tangible. Let's start small. Imagine you start with $10,000 in a monster dividend portfolio. You've selected your high-quality stocks, set your rules, and you're reinvesting every dividend. Assume an average dividend growth of 10% per year, and fully reinvested. Over 30 years, your $10,000 doesn't just sit there. It compounds and grows into roughly $350,000, paying around $3,000 per month in dividends. That's life-changing. Not overnight, but consistent, compounding, unstoppable growth. Now let's look bigger. $50,000. Same rules, same reinvestment, same 10% growth. Over 30 years, that becomes roughly $1.8 million, generating about $17,000 per month in passive income. That's more than most people make working full-time. And if you start with $100,000, your portfolio grows to roughly $3.6 million, delivering over $30,000 per month in dividends alone. All of this without leveraging, without speculating, and without timing the market. Just time, discipline, and compounding. This is why starting early is everything. Even if you can only invest $200 per month over decades, the math still works. And here's the kicker. Dividend reinvestment accelerates the process exponentially. Let me show you why. Imagine two investors, Investor A and Investor B. Both start with $10,000, same stocks, same yield. Investor A reinvests dividends automatically. Investor B takes dividends as cash and spends it. 30 years later, Investor A's portfolio has compounded into a massive dividend engine. Investor B, their portfolio barely grew beyond the initial investment. Reinvestment is non-negotiable if you want the monster portfolio effect. Now let's talk SCHD, one of the most popular dividend ETFs for a reason. SCHD isn't flashy, but it's exactly what a dividend-focused investor wants. Over 100 high-quality U.S. dividend-paying companies. Average yield, 3.5%. Low expense ratio, 0.06%. Long-term historical returns, or 12% per year. SCHD gives you diversification in one ticker. Instead of picking individual stocks, worrying about sector risk, or tracking 10-plus companies, you get a ready-made portfolio of solid dividend stocks. And since dividends are reinvested, your snowball starts immediately. Here's how it plays out with real numbers. Suppose you invest $10,000 in SCHD today. With average dividend growth of 10% per year and full reinvestment, 30 years later, that $10,000 grows to roughly $350,000, paying $3,000 per month in dividends. That's exactly the same as the individual stock example, but without the stress of monitoring multiple companies. Now scale it. $50,000 invested in SCHD grows to $1.8 million, paying around $17,000 per month. $100,000 grows to $3.6 million, generating $30,000 per month. Same principles: discipline, reinvestment, time. And because SCHD holds multiple companies, your risk is significantly reduced compared to individual stocks. Let's also consider long-term dividend growth projections. SCHD focuses on companies that have consistently raised dividends for years. If we assume conservative dividend growth of 7 to 8% per year, slightly below historical averages, instead of 10%, you still end up with substantial passive income. That's why dividend growth, not just high yield, is the key. Let's break down the psychology behind it. Many investors fail because they expect instant gratification. They buy a stock, see a 1-2% yield, and panic. They see high yields and assume it's safe income. They don't understand the snowball effect. The truth is, the first 5 years are slow. You might only earn a few $100s in dividends initially. It's tempting to quit or chase yield. But if you stay consistent, reinvest, and let time do its work, the growth is exponential. Consider Microsoft again. Dividend yield today under 1%. Sounds tiny, right? But it raises dividends over 10% per year. In 10 years, yield on cost jumps to 3 to 4%, in 20 years to 6 to 7%, and beyond. That's how ordinary investors can build massive passive income without ever touching principal. Now, diversification isn't just about safety, it's also about predictable growth. You don't want one industry deciding your financial future. Airlines during COVID? Disaster. Energy during oil crashes? Volatility. That's why the monster dividend portfolio usually includes 7-10 strong companies across 5 to 7 industries. Enough diversification to reduce risk, but not so much that managing the portfolio becomes overwhelming. Let's talk monthly cash flow. Suppose you start with $50,000, reinvest dividends, and add $500 per month for 30 years. With dividend growth, your monthly income from dividends alone can reach $20,000, $25,000. That's not magic. That's math. That's time compounding on disciplined investing. Even starting with $10,000 and contributing $200 per month can eventually give you $3,000 per month in passive income. Some people ask, why not just buy high-yield stocks and skip the growth? Here's why that's dangerous. High yield often comes with hidden risks. Companies that overpromise dividends to attract investors, often with deteriorating fundamentals. When profits drop, dividends get cut, and you're left with declining income and a falling stock price. That's exactly what happens with companies yielding 7 to 10% without strong balance sheets. Dividend growth, combined with reinvestment, flips the script. Even starting small, you benefit from compounding, time, and consistent company growth. That's why people who start early, even with modest amounts, can retire decades later with income streams that rival or exceed their working salary. Now, let's visualize $100,000 invested in SCHD over 30 years, reinvesting dividends and contributing $1,000 a month. Using conservative 10% growth, your portfolio grows to nearly $5 million, with monthly dividend income exceeding $40,000. That's financial freedom. That's replacing a full-time income without touching your principal. And here's the best part. You don't need to time the market. You don't need to chase trends, guess which stock will spike, or gamble on speculative sectors. High-quality dividend growth stocks and ETFs like SCHD give you reliable compounding income that grows even during market downturns. Stocks may drop temporarily, but your dividends continue to accumulate and reinvest, creating an unstoppable snowball. Another pro tip: automatic reinvestment is key. Set up a DRIP, dividend reinvestment plan, or use your brokerage's automatic reinvestment option. The moment a dividend is paid, it buys more shares for you. No thinking, no timing, just compounding working silently in the background. Lastly, let's talk mindset. Most people fail because they measure progress by today's income, not the long-term trajectory. Don't fixate on whether you're making $10, $50, or $100 a month in dividends right now. Focus on consistency, reinvestment, and letting compounding do the heavy lifting. Over decades, even modest amounts snowball into extraordinary income. So here's your action plan to start building a monster dividend portfolio today. 1. Focus on quality companies with consistent profits and dividend growth. 2. Ignore the allure of high yield alone, prioritize growth and sustainability. 3. Reinvest every dividend automatically. 4. Diversify across 7-10 strong companies, or use ETFs like SCHD5. Start small if necessary, but start now. Time is your most powerful ally. 6. Track growth, reinvest consistently, and resist panic during market dips. By following these steps, you're no longer trading hours for dollars. You're building a machine that generates income, grows with time, and survives market downturns. Even if you start with $10,000, $50,000, or $100,000, the dividend snowball will eventually produce monthly income that exceeds your living expenses. This is the beauty of dividend growth investing. Not hype, not speculation, not luck, just time, discipline, and compounding. And that's exactly why this strategy works even for ordinary investors like you and me. Start today, stay consistent, and let the snowball roll. In a few decades, you'll look back and realize the money isn't just sitting in your portfolio. It's working harder than you ever could, quietly, steadily, and exponentially. You teach viewers how to build a monster dividend portfolio that grows steadily over decades, generating reliable passive income. You start by addressing the common fear many people have: working hard, saving, and investing, but never truly achieving financial freedom. You explain why saving alone won't secure your future, and why dividend growth investing, not chasing high yields, is the key to building wealth that pays you to live. You break down the fundamentals of dividends, what they are, why they matter, and how reinvesting them can create a compounding snowball effect. You illustrate the danger of high-yield traps using examples like Verizon, and contrast it with dividend growth companies like Microsoft, Johnson & Johnson, and Coca-Cola, showing how steady growth over time beats short-term income. The video then moves into practical portfolio building guidance. How to select safe, high-quality dividend stocks. Understanding payout ratios and avoiding dividend cuts. The importance of reinvesting dividends for exponential growth. Diversification across 7 to 10 stocks, or use ETFs like SCHD for simplicity and risk reduction. You provide real-world step-by-step examples showing how starting with $10,000, $50,000, or $100,000, combined with reinvestment and consistent contributions, can turn into thousands of dollars per month over decades. You explain how ETFs like SCHD simplify diversification, maintain consistent dividend growth, and help investors build substantial passive income without having to manage dozens of individual stocks. Finally, the video emphasizes mindset, discipline, and long-term thinking, staying consistent, ignoring short-term market noise, and letting compounding and time do the heavy lifting. Viewers are left with an actionable blueprint for building a portfolio that generates life-changing income over time, proving that ordinary investors, with the right strategy, can achieve extraordinary financial freedom. You teach viewers how to build a monster dividend portfolio that grows steadily over decades, generating reliable passive income. You start by addressing the common fear many people have: working hard, saving, and investing, but never truly achieving financial freedom. You explain why saving alone won't secure your future, and why dividend growth investing, not chasing high yields, is the key to building wealth that pays you to live. You break down the fundamentals of dividends, what they are, why they matter, and how reinvesting them can create a compounding snowball effect. You illustrate the danger of high-yield traps using examples like Verizon, and contrast it with dividend growth companies like Microsoft, Johnson & Johnson, and Coca-Cola, showing how steady growth over time beats short-term income. The video then moves into practical portfolio building guidance. How to select safe, high-quality dividend stocks. Understanding payout ratios and avoiding dividend cuts. The importance of reinvesting dividends for exponential growth. Diversification across 7-10 stocks, or use ETFs like SCHD for simplicity and risk reduction. You provide real-world step-by-step examples showing how starting with $10,000, $50,000, or $100,000 combined with reinvestment and consistent contributions can turn into thousands of dollars per month over decades. You explain how ETFs like SCHD simplify diversification, maintain consistent dividend growth, and help investors build substantial passive income without having to manage dozens of individual stocks. Finally, the video emphasizes mindset, discipline, and long-term thinking, staying consistent, ignoring short-term market noise, and letting compounding and time do the heavy lifting. Viewers are left with an actionable blueprint for building a portfolio that generates life-changing income over time, proving that ordinary investors, with the right strategy, can achieve extraordinary financial freedom.